Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Well, welcome back, everybody. Been interesting watching what's going on around the entire world as everybody gets ready for our election that's coming up. That should be pretty interesting. Always something for you to consider, especially with your investments. And when I say that, I'm talking about just considering something you probably should be doing on a regular basis anyway. But with this particular election that's coming up and looking at what the two parties might be doing, it's really, really difficult to say what might happen. I don't really anticipate that a lot is going to happen. I think that both the presidents are, no matter what they do, have looked at their policies. Even though they say Trump doesn't have policies, he does. He's in the corner of big business, and most people are. By the way, even though that 95% of the businesses in the United States are small, we're actually a country made up of small businesses. But the big businesses have such a huge impact. It's like any other statistic. I always love this. When you're looking at statistics, you got to be really careful when you're looking at averages, because one number, back in the day, we used to call it an outlier. One instance can come up, and the number can be so large that it has a larger than normal impact on all the numbers that you have. And I'll just give you a really quick example. Let's say you were counting, I don't know, just something, and each one of them comes up with a number one, or there's only one participant, there's only one outcome, and it comes up 99 times. Okay, and so everybody's thinking, all right, well, the average is going to be 1. Why? Because it comes up 99 times, and we're all getting up to the 100, and we're going to only use 100 as our sample size, and we're getting ready, and it's going to be 1. Okay, and then on the 100th time, it comes up 1,000, or actually, it could come up 1,000 on any one of those 100 tries. But if all the other ones are 1, well, the average is going to get skewed big time. So, and that's one of the things that could be happening right now. There really hasn't been conditions like this. Economically, we're doing pretty well. And the economy is doing very well. It did well under Biden. It did well under Trump. It's doing well now. I think, of course, it's going to go up and down, and you have to be willing to accept that if you want to make decent returns over time. And, having said that, if you want to make decent returns, stock markets, its long-term average is pretty high. The average balanced fund is actually really pretty high as well. In fact, it's more than most people are going to make on their savings accounts, more than most people are going to make in their bank accounts, but it fluctuates a lot. And I guess that's the biggest problem. I know it is the biggest problem. You get a lot of fluctuation. I'm looking at a moderate allocation. That's a balanced fund. This is one of the more successful, and it's actually from Fidelity. It's basically just a balanced fund. That's what they call it, the Fidelity Balance Fund. And I'm looking at how it's done. Well, in 2021, it actually started to correct a little bit early, more than a lot of the funds did. So that correction, by the time it bottomed out in 2022, was down about 22% or so, almost 23%. That's a lot for a balanced fund. And by the way, that took a year. So the horrendous year because it kept going lower and lower and lower. Every time it rallied, it would go up a little bit, give everybody hope, and then turn and go right back down again. So those are really aggravating, by the way. But in 2024, it surpassed that old high that it reached in November 21. And now it's up about 14% above, and that's not all this is not including the dividends, which reinvested would have added some more money to it, and especially with the balance fund, because you got a lot of money in bonds. So if you're reinvesting dividends, your actual returns probably around 4 or 5% a year. After starting at the worst possible time you could have started in the last 5 years, so it's kind of a key. You really have to stay long-term focused. And I know we've talked about this. Everybody talks about this. It's very common in the industry. You need to stay focused on long-term. And I get it. And they're absolutely right. That's what you need to do. Sometimes you may not be able to. Just because you are focused on long-term doesn't mean you should ignore higher than normal risk that you might have in your portfolio. Yeah, what do I mean by that? Well, if you've got 65% of your money in stock funds and you're past the age of 60, okay, that unless you have a fairly decent risk tolerance, it's got to be fairly high. You're probably overweighted in stocks. You might want to cut that down to 40 or 50%. What would you do with that extra money? Well, bonds are paying decently well, but the rates have started to come down now. So you may want to lock in some higher interest rates with annuities that are available out there. They're fixed annuities. You can get annuities that have schedules that go out a really long time. One of the ones I like to use, it actually has a guaranteed income. And once you've locked that in, you're done. You're good. And every year that you don't take it, it goes up. Now, I can't go through the whole, what happens if you started at 50, what happens if you do that all the way up to 100, or even 70 for that matter. But it's a very good concept. The income's going to be higher than what you'll probably get on bonds. I know it is. And it's going to be higher than you could get on treasuries, Social Security. And once you take that income, once you finally turn it on, it stays. Okay, it's going to stay at that level for as long as you live. And if you pass away, that's one of the reasons I like the one that I'm using now. It's if you pass away, whatever's remaining goes to your beneficiaries, not back to the insurance company. And we'll come back to that stuff a little bit later. But I just wanted to let you know that things really, they're actually looking pretty good economically, especially. And by the way, the economy doesn't lead the stock market, incidentally. I know I've run into a lot of people who used to think that when we started working together, the economy goes down and then the stock market goes down. No, actually, the stock market typically goes down before the economy does, because they've been doing this. The people in my industry have been working here for most of them all their entire careers, and there are thousands, literally thousands of portfolio managers, thousands, probably hundreds of thousands of analysts, and their job is to keep an eye on things and watch very closely. And so they're normally typically out ahead of what the market's actually going to do, although you can't make a perfect argument for any of this stuff. But they generally are running out ahead, and they're making decisions and making moves before they talk about it on television. Where can you see it? Well, you can take a look at various indexes, and if they are turning and starting to head down, I'm talking about industry indexes. I'm talking about large cap, mid cap, small cap. Just take a look overall at those indexes and what direction they're going. And this is one of the reasons that people like myself still have a job. We're still doing that. It's a lot. I mean, if you like it, it's not any problem at all. And this is heck, I grew up on this, so I really enjoy it. It's not do I enjoy the market going down? Not really, but it doesn't bother me nearly as much as it would bother someone else. I have great confidence, especially in this economy, especially with where we are now. There have always been a couple of huge industries that were driving economic expansion. And sometimes, by the way, those huge industries that people flock to, they end up employing a much larger percentage of the population than they did before that caught on. The economy grows again, and once it grows, it's really tough to go back. You can't shrink it back down to where it was before. To keep that from happening, that's actually not why the Fed does this. But when they print more money, prices have a tendency to go up, and prices never go down. I mean, they never go down. If they do, it's only temporary, and then they start marching right back up again. That's one of the reasons it's so important to have a well-rounded strategy. When you get ready to retire, you really need to take a look at how much money you have, how much growth you're going to need, how much income you're going to need. It would be nice to shoot somewhere between the 4 to 6% range. That's where you want to kind of be. You don't want to go above 6, and most of the time there's no need to go below 4%. But as a retirement planning 101, you want to stay in that 4 to 6% range. I've seen some people who thought that 10% would be a good number because they heard that the stock market averaged 10% over the long run. Well, it has, and it does, but it has multiple periods where it goes down a lot and doesn't recover right away. If that happens and you're counting on taking out more than 4 or 5% or 6% max, you could end up looking for a job in retirement. And I know most people don't want to do that. So you got to be really smart about this and say, okay, I'm going to shoot somewhere between 4 and 6%. I'll start off taking 5. If you don't need it, by the way, don't take it. I've got a client, and actually I've got several clients like this. It's not just one. So that they think that if they ask me to do something for them, that I'm going to be able to do it just because they asked. That blows my mind. And then they always ask, when I give them the options, they're always picking the highest one. As I say, look, you should probably stick to between 4 to 6%. It's 6%. Yeah, we can do it. And okay, let me show you what that means. And they show the volatility, how much it goes up and down. You got to be prepared for that. That's really what retirement planning is all about: getting your income to a point that even if the market goes down, you have confidence that you'll make it through, because the last 50% drops, you made it through. And it means probably not taking out every dime in profit that you've made. You're going to have to reinvest that, because at some point in time you're going to have a really big drop, and you need to make it through that period. And if you took all the profits out along the way, you wouldn't. I mean, you just wouldn't. The amount of money that you had invested would drop to such a low level that continuing to take it out, you'd end up running out. So that's a very, very difficult conversation to have with an awful lot of people. And there's a 4% rule, if you've never heard about it. And I know everybody that's listening to my show has heard about it many times. But it's realistically, you should try to shoot for only having to take out 4%, because you're going to have to adjust that on your first year of retirement, because you're going to have to adjust that for inflation over time. So you start off at 4, and then you add inflation. And most of the time, a well-diversified, balanced account, stocks, bonds, and cash, that number's going to, the amount that you have in each one's going to be different depending on your personality type. But if you're not going above 2/3 of the money in stocks, that should allow you to take out 4% plus inflation each year. So when you first start, your inflation rate's been between 4 and 5%. That's the average that it's been over the past 60 to 70 years, actually going back to the Depression. But it's really funny when I say that to a lot of 40-year-olds. They go, "What? Depression? What's the Depression?" And now I'm showing my age. But for you people that are 60 or over, you know what that is. So going back to then, 4 or 5% annual withdrawal, increasing it for inflation, and see, that's where it gets people. They look at 4 or 5% as if it's just going to stay that way, forever. Well, no, we're factoring in that inflation. And I've got about 30 seconds here before I have to take a quick commercial break. So I'm going to stop this here, and we'll pick this back up right after these commercial messages.
Here I am, all my intentions.
Hey, so question for you. Have you ever been through a Cleveland winter before? The harsh weather is on the way, and if you've got a leaky roof right now, or if you've got shingle issues, you need to take care of those, and you need to call Sky Roofing right now. If you've had leaks repaired in the past, maybe by a company that isn't around anymore, don't go with the fly-by-night storm chaser companies. Go with a company that's been here for a very long time and is going to be here for a very long time to come. Talking about Sky Roofing, taking care of homes and buildings in Greater Cleveland just like yours for over 22 years. So if you've got leaks, if you've got shingle damage, you need to get those things taken care of. Or if it's time to replace that roof altogether, call Sky Roofing, 440-349-6750. And if you've got new construction and you need a roof put on a new building, you call Sky Roofing. Take advantage of great rates on 5 to 7 year financing, including 12 months, same as cash. Call now, 440-349-6750. Sky Roofing is roofing done right.
There are 2 radio stations in this city that aren't like any others. One gives you the real news and issues and honest analysis from some of the best talkers in America. The other gives you music and entertainment that's safe for the whole family. Something you and your kids can actually listen to together. Oh yeah, we're different, all right. For real news and information, turn to AM 1420, The Answer. And for entertainment, safe for the whole family, turn to 95.5, The Fish. Because different is good.
No doubt about it, we're spending more time at home, which is the perfect time to make it more functional and beautiful. Hi, Ed Flash Ferentz here for Artistic Renovations, Northeast Ohio's premier and award-winning remodeler. Artistic did a fantastic job with our kitchen in 2016, and last year, they were back for the master bath. Oh my word. Do yourself a favor and go to artisticreno.com. Believe me, you'll love their ideas and without question the finished product. For a virtual consultation, call 216-520-0838 or visit artisticreno.com.
You've heard the saying, all good things come to an end. Well, not always. Sometimes they just take a break. That's what's happening with Our Lady of the Wayside's car donation program after 24 years and 96,000 rides donated. Pretty amazing. Here's the story. The car lot's owners sold the property, making it impossible for car donations to be accepted at this time. According to the Wayside CEO, Terry Davis, the next right steps will be determined and communicated soon, so stay tuned. In the meantime, Terry and the entire team at the Wayside thank you for your continued support of the 450 individuals with developmental disabilities in the Wayside's care. And please take note, you can still support them by making a donation at thewayside.org. Thinking about updating your home? Well, Joyce Factory Direct specializes in replacing old, outdated windows. Proudly made right here in Cleveland, Joyce Windows features their exclusive Smart Shield high-performance glass, which means you'll be getting the most energy-efficient windows for your home directly from the factory. Customers just love how much warmer their house is and how easy their new windows operate and clean. Right now, you can save 50% on all installations. Just call to schedule a free consultation with on-the-spot pricing, 440-243-5700, or visit joycefactorydirect.com.
Well, welcome back. Welcome back. Welcome back. Yeah. And I've gotten this. I put out a newsletter, and I get to go through and I get to select the articles that are going to go out. And I've selected a lot of them this week that have a lot to do with taxes coming up, because you don't have a whole ton of time to get things done before the end of the year. You could do any. There are a lot of things you can still do for the end of the year. And so this week's newsletter talks a lot about them. And I just thought it was kind of interesting. The one of the articles, and this was from the Wall Street Journal, it was called "Cut Your 2024 Taxes Before It's Too Late." And it gives you some pretty good ideas there. And you can check your withholding estimated taxes, with withdrawals from inherited traditional IRAs. There are the laws just changed with that again. They're constantly changing, by the way. That just drives me nuts on how much material comes out each and every year. I mean, the pages are in the thousands. So, and I'm not a tax preparer. I don't think I'm ever going to be one. And it's against the rules for RIAs who don't have tax preparers licenses to give income tax advice. So all I can do is tell you or refer you to these articles if you wanted more information on it. We're not supposed to be fielding questions on this kind of stuff, and tell you to show these articles to the tax preparer that you do have. I've been using the tax preparer for a long time. I hope he doesn't retire, at least not anytime soon. And his name's Bob Klingman, and he's a really good guy, and he really likes this stuff. It's funny how much how excited he gets about it. I'm just like, wow. Well, I'm glad somebody does, and I'm glad he'll work with my clients. So when they have questions, I have him on retainer, and so he'll answer questions. We'll get him back on the radio show here in the next couple months or so, because there are a ton of things that have happened. I can't remember this much happening over this short of a time period for a very, very long time. And but there are some pretty significant ones, especially if you are inheriting IRAs. If somebody has passed away that was a close family member and they left you money in an IRA, you need to get some advice on that, because you do have significant options, and it will have a big impact on how much money you pay in taxes. So, again, if you want to call me, that's fine, and I can put you in touch with Bob. Shoot, I forgot. I don't have his card in front of me. Yeah, so call me. I'll put you in touch with Bob, and next week I'll have one of his cards with me, so I can give his name and number out. But if he wants me to, I don't know if he's still going to want me to. He's been doing this for a very long time. He may not want to take any more clients. I didn't talk to him about this before I started talking to you about it. But anyway, I doubt it. He's a pretty good guy, and very hardworking, and the kind of guy you really, really like, and one of the people that you want to have on your team. And anyway, so that was part of the newsletter that I sent out. It was Cut Your 2024 Taxes Before It's Too Late. And one of the others was how investors can brace for election uncertainty. which I think is also pretty interesting. What if ignoring politics is the wrong move this time? The spoiler alert! Oh, spoiler alert! I can't talk at all this morning. The what if ignoring politics is the wrong move this time? And I think that I like the way that they write these articles because I mean they're setting you up. They know what people think. You know, if I know which person is going to get elected, then I can figure out what the economy is going to do. Really, you know, you would get a you would be one of the most wealthy people on the planet if you could figure that out. And every year, everybody that knew who was going to get elected, at least the ones that voted for the ones that did get elected, would know what to do. And there are things that you could do if you could pick out a 5 or 10% move in markets overall. Okay, I can show you how to make investments on that will make you rich. I mean, rich. But you have to know exactly. And see, that's the point. That's my point. Since nobody is becoming a multi-billionaire, and there aren't thousands of them across the world that are doing this every time an election comes up in the United States, because it's a world economy now, and it's been a world economy forever. But if the United States has a big impact on all that, but you would be able to make so much money, you would never have to work again. That should tell you something. It must be pretty difficult to do if the world's not minting several thousand billionaires every year from the investment world, from stocks, not building a great business and going public, which is the way that many companies in the United States do it. So anyway, it's very, very, very difficult. So, and incidentally, the path you're going down is typically going to be the path that you're going to use going forward until it isn't. Very helpful, right? Yeah, but if you've been doing this a long time, you'll realize that the value in that statement. Essentially, it's do not try to forecast what you think markets are going to do, because the chances of you getting that accurate enough to make a difference in the returns on your investments for the rest of your life, that is almost impossible to do. And if it were that easy, I mean, think about it. If it were that easy that somebody sitting from home, and I know everybody that when I say this, I've got people that are former engineers that work for NASA. Those guys are really good at math, as you can imagine, and they can tell you that it's not easy. None of them are multi-billionaires from their investment portfolios, because that's how hard that is. So the main, I don't know, I guess ideas that have always been, you've always heard bantered about is stay diversified. Yes, that's still really important. Some of the stocks are going to do exceptionally well. Some of them are not going to do well at all. And again, since you can't predict the future with a high degree of accuracy, you just spread it out and then rebalance. That's the key. The rebalancing, and it's not like rebalancing has to be done more than once every other year or so. That's another thing that is not too highly touted or not talked about a whole lot in my industry. How frequently do you need to rebalance? Well, it's not like the market understands that you need a calendar date to make your rebalance easy for you. Yeah, it's not going to do that. Sometimes you don't need to rebalance for 2 or 3 years in a row, and other times, maybe you might have to rebalance 2 or 3 times that year. Yeah, unfortunately, that's not very common. In fact, it's very uncommon. But most of the time, a longer time period. When I backtested all the way back to the 1920s, which strategies would work best there, I came up with every other year. So basically every 2 years, going in and rebalancing the portfolio did the best over that particular time period. That doesn't mean that might not change. It's just that with all that data, it's not likely to change a lot. So you only need to do it about once every other year. I think people also, they go a little bit nuts over politics, over what's going to happen. You know, when you look back over all the presidents, Democrats, Republicans, for the last 100 years, for the vast majority of them, okay, there's not much difference. There's literally not much difference. And most of them were victims of whatever was going on in the economy outside of politics. That was what was happening. That was what had the biggest impact on their investments, and on the financial markets, and on your investment. So given the fact that it's really difficult to forecast what's going to happen in politics, forecasting what's going to happen in politics makes forecasting the stock market look like it's easy, which, of course, we know is not. So it's just really different. That's why you have to come back. And I figured this out a long time ago. What really killed me was all these other companies that are money management and financial planning firms. They have these really complicated questionnaires to try to figure out exactly what kind of a risk taker you are. And I'm looking at this nonsense, and I'm going, man, people don't understand the questions. How can you gain anything useful if the person answering the questions doesn't understand the question? And I railed against that forever. And then I came up with my own methodology. And here it is. I'm about to tell you. And the reason I'm about to tell you is because about 2 years ago, these knuckleheads, after making all of our investment advisor lives miserable by forcing us to ask these stupid questionnaires that the people signed on, and they got stored away, and every time somebody said, hey, I don't think this is what I should be doing, they would pull that thing out, which was meaningless to everybody in the first place. It didn't help. So, and I'm standing out there all by myself saying, hey, look, figure out how much of a decline you think you could take in your portfolio. If you're down 20%, are you really are you so upset that you're losing sleep? And that was my, basically my methodology. How much of a decline can you take in your portfolio without losing sleep? And understand that if you tell me, well, I don't want any fluctuation, okay, well, you're going to get whatever is in a money market or short-term CD rates or short-term government bonds because you can't take any risk. If you see something moving down, which incidentally is impossible outside of anything under short-term CDs or treasury bonds, and here's, when interest rates were paying 1%, that would have been really, really rough. Now, you'd have never been kept awake at night if you're buying short-term CDs and short-term treasury bonds that were paying less than 1%. But there was a time period there where you weren't making almost any money at all, and inflation, by the way, was still there. Okay, so you have to take on some risk. You have to be able to take on some fluctuation. Otherwise, you're making a big bet. Okay, you're a gambler. You think you're conservative, but you're not. You're a gambler because you're gambling that the short-term interest rates are going to be high enough to give you an income that you'll be happy with. Never mind that there's inflation and taxes you have to pay. People ignore that all the time. But they just look at that overall rate. You can't do that. You got to step back. Look at the big picture. Which asset classes have had the best long-term gains? Long-term gains. 10-year time periods. How many 10-year time periods have there been in the past 100 years? A lot. You don't have to count it or try to do the math in your head. So over that time period, if you're looking at 10 years, you could look at 20, 30, it doesn't matter, whatever you want to look at. As long as it's minimum of 10 years or longer, what kind of portfolio could you have put together that would have a a somewhat positive return despite what happened over that time period. And what you're going to come up with is a much larger percentage of bonds, and but there's still going to be some stocks in there. And most people are using the S&P 500 for that, by the way, just to figure out what they should be doing, what stocks are, giving themselves some kind of example. Because most actively managed, those are funds where professionals pick stocks, and index funds now. And we use mostly index funds because, and by the way, when I say index funds, people are like, oh, you're just using the S&P? No. There are thousands of indexes out there. I mean, literally thousands. And the fact that you didn't know that, well, and you're making decisions over your own portfolio, wow, you guys are brave. And I see that kind of stuff happening all the time. So you need to, in other words, you just need to know a little bit more about that. And it's not like it's going to, it's kind of like forgetting to put, a small amount of a certain ingredient or salt into a lot of dishes that you might be making. You might only be putting a tablespoon or less of salt in there, but boy, you try that food without it, and it's really rough. And it's like yeast in a loaf of bread. Yeast has a percentage of that loaf of bread, of all the ingredients that you put in there, is incredibly small, but it has a major impact. That's what planning can do for your portfolio. If you're not planning and if it works out, it's going to be luck. Okay, you need to have some idea of what kind of risk you want to take, and then build your portfolio around that. And it's fine to take a look at multiple risk levels and say, well, if I felt like I could be down 30%, and my number that I have is 40. If I'm down 40%, I am not happy. I promise you, I'm not happy. But I know I'm not going to zero. I am definitely not going to zero. I mean, unless U.S. government decides to stop paying back the treasuries, which, since they own their own printing presses and you can just print the money and hand it to you, the likelihood of that is nearly zero. So notice I said nearly zero, because in the worst of all circumstances, something like that could potentially happen, but the Browns may go undefeated for 5 years in a row, too. Anyway, I've only got a few seconds before I have to take a really quick commercial break. If you'd like to call in, 216-901-0945, 216-901-0945. This is Bill Bullington right here on 1420. I'll be back after these commercial messages.
Wish I could describe it, but I can't contain it, can't keep it to myself.
Wallacadoodle delayed? Is Wallacadoodle denied?
And since we're the home of Wallacadoodle,
we're making same-day water heater replacement and always-on offer.
Since no one wants to do cold showers, other than CrossFitters and such,
we'll replace your water heater and Wallacadoodle your plumbing same day.
Call us before noon and we'll get it done the same day.
Even upgrade you to tankless.
Or add a whole home water filtration system.
'Cause your tap water has more chlorine than the average swimming pool.
And chlorine is like the peel on a banana.
You want chlorine while the water is processed and traveling through your pipes.
But it's time to take it out before you drink it or shower with it.
And that's what a water filtration system does.
It also takes out other chemicals you don't want to drink.
So if you want same-day water heater replacement,
don't settle for anything other than same-day Wallacadoodle.
Just call us and
consider it done at WyattWorks.com.
Do you ever find yourself saying, I need a vacation? Vacation Fixation can help. At Vacation Fixation, we specialize in all-inclusive trips and cruises to Mexico, the Caribbean, and Disney vacations. Why choose us? Our clients book through Vacation Fixation because they are frustrated with online trip brokers and timeshare scams. Whether it's a weekend getaway, a family trip, spring break, or honeymoon, Vacation Fixation will personalize a trip just for you. Want to know the hottest destinations in Cancun, Punta Cana, Jamaica, or Puerto Vallarta? Interested in room upgrades, beach reviews, or details about resort restaurants? How about finding a trip with a direct flight? At Vacation Fixation, we take all of your specific travel requests and shop our suppliers to find the best deal. What's the cost? Our suppliers pay us so you don't have to. Call 330-573-8147 for more details. Or you can visit our website at vacationfixation.com or check out the deal of the day on Facebook. Vacation Fixation.
Is it finally time to update your bathroom? Bath Planet, a division of Joyce Factory Direct, specializes in replacing and converting old showers and tubs into new, beautiful bathrooms in as little as one day. We have transformed thousands of bathrooms just like yours into a spa-like oasis that has homeowners excited to use their new bathtub or shower. Right now, all bath installations are 50% off. So call to schedule a free consultation with on-the-spot pricing. 440-243-5700 or visit joycefactorydirect.com.
Well, welcome back. It's just the starting. I did a illustration here. One of the reasons you don't need all of your money in stocks, because we've just been talking about how volatile they can be, how long it can take to recover. There's a 10-year period that would happen during the last 20 years that you wouldn't have made any money. I mean, if you did, it was very little. And that's pretty rough. Now, somebody in a 401k plan, incidentally, somebody's always going to call or send me an email, well, I made blah, 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 blah. Well, that's because you were adding to your 401k plan. And, yeah, when stock prices get cut in half, and let's just keep my math simple here, for every $100 that you were investing, if that share price went from $20 a share down to 10, instead of buying 5 shares a month, you're buying 10 shares for the same $100, okay, per 100. Okay, so if you're doing 1,000 or 2,000 or 4,000 or 5,000, all the better. And yeah, that's key. It's done very well. But if you were an investor who was retired and were taking money out, I promise you, much different outcome. And the reason that you have things like fixed annuities is because they have a guaranteed income. That income stream is guaranteed by the insurance company. That's how those contracts work. The insurance company is going to guarantee an income, and one that I like a lot. When I have a very big chunk of my retirement savings. Why? Because I don't want to think about it. I just don't want to think about it. I know I get full retirement age, and I don't get penalized for taking money out of, or making money and still taking full Social Security, which is age 67 for those of you that don't know. You can keep making as much money as you want without getting penalized, without having to pay back some of the Social Security, or they'll just actually cut your payment. But you don't want to get penalized when 67 is full retirement age. Okay, so after that, you can continue to make out whatever you want to make and take your Social Security. And I've seen some people who decided to put it off to age 70, and up to age 70, they guarantee that it'll go up each year by a certain amount. After that, they don't make any guarantees. So the chances of it not going up are pretty remote, but anyway, it's only guaranteed up to a certain level. So bottom line is, when I get to age 70, and right now I'm 62, can't believe, actually 61. I'm going to be 62 here in a few months. Just a few months. Wow, that is mind-boggling. I never thought I would make it this far, but if you'd have known me when I was younger, you'd have known why. So anyway, the $100,000, age 70, putting it in at 69. No, that actually is for today. Let me see this again. The income is $8,256 in this example. Okay. Now, if I put it off, it goes up to $9,000. If I put it off again, it goes up to $9,891. If I put it again, it goes up to $10,718. And there is a schedule that each year, if you decide to put it off till the next year, it'll continue to go up. At age 79, that 100,000 you started with at age 69 would give you $18,917. Okay, because you put it off for 10 years. That's just putting it off past that point. It'll still probably go up, but they just don't guarantee that it's going to go up by that much. So that's a really nice tool to have. The income is generally much higher than you can guarantee from a CD or a treasury, and you can't make any guarantees when you're doing funds. I can guarantee you this: if you're doing 100% funds, you're going to have a tremendous amount of volatility, especially if they're all stock funds. And so this is a nice tool. Sometimes you can bring it in, set a base income, make sure your basic needs are covered between Social Security and what you get. And that's basically what I did. I said, okay, Social Security and annuity, how much income do I want? And so I went out and purchased that. And so now I know anything else I get is just for gravy. Trips I might want to take. Maybe I want to get a fancier new car. I doubt it. But anyway, it gives you the ability to have that extra cushion there. And that's why I really like this, because you can do some really long-range planning with it. And it's a good idea. I will tell you this. I've been talking to people. The max issue age on this is actually age 80. So once you get past 80, there are some annuity companies who will give you a good product. The interest rates are slightly higher than they are on CDs for the vast majority of them. But you can take life only options. I've been working with a guy and trying to find this a product. It's what brought it up to my mind. Is in his early 80s. And we're out there looking, and there are some insurance carriers, that will give you a contract, and they'll guarantee a life only with a refund option. That's really difficult to do, incidentally. Life with a refund is when you get past the age of, say, 75, those are getting rarer and rarer by the day, by the month. And so with that kind of stuff, that they're very competitive. When you do a life option, they're looking at your life expectancy and expecting you to draw down to zero. So if you're liquidating your principal plus any interest that they're giving you, it's like a reverse mortgage. The payment is generally a lot higher than interest alone by far. And so anyway, if you have any questions on that kind of stuff, feel free to call me or drop me a line. I can give you a call, and we can take a look at it. We shop, I can't even tell you how many hundreds of annuity companies there are in the databases of the vendors that I'm using. These guys, it's all they do. They specialize in there. I use 3 different companies across the country, and it's a lot of work, I can tell you that. But this is important. Once you've already retired, and these types of investments generally, penalties can range from 8 to 10% on a lot of them. So you don't want to make a mistake, because you don't want to have to get out early and pay a penalty. That's not the goal. The goal is to move forward, not backward. And anyway, just thought I'd bring that up. And I'm trying to think here. There were the smart money decisions. There was an article that I sent out this week, and they're talking about certain really smart things to do, and considering Roth IRA conversions was one of them. And I'm going to tell you, you better get a tax preparer that knows what he's doing. And some of these articles, as much as I like them, and yeah, they're talking about great things, and I just had to order some software because every year it changes. And so I ordered some software. What happens if we did a Roth IRA conversion? What are we going to do in that case? And I've had a couple instances where people have just inherited Roth IRAs, and they changed the rules on this stuff. And I feel like I know what they're doing. It's to keep tax preparers and tax attorneys and CPAs really busy, because those guys make a pretty good buck giving this advice out. And if they have to work on it every year for a long time, they're generating hundreds of millions, maybe quite possibly billions of dollars in fees just for advice. And it's killing me. But anyway, the article talked about don't forget to take your required minimum distribution, and that is something, definitely. If you haven't taken it out this year, call your firm, call the advisor. Let me give you a little hint here. Most of them only tell you about the ones they have under their control because they don't know what you have outside of their firm, and they're not going to know. And so the advice that they give you, everybody's got big disclaimers on that. It's, ultimately, it's your responsibility. But you say, well, but I don't know how to do it. How could they hold me responsible? Because they're the United States government, and that's how they work. They hold you responsible for stuff complying with laws that they know you don't understand. And so basically, you're going to have to go and find somebody that does this for a living, or can point you to someone who does and help you make those calculations. And a lot of the broker dealers will help you with that. They have the software, and that's another. It's a big money grab, man. These guys pass these rules, and all of a sudden the software is coming out. And, hey, you need to upgrade to this year's software. Yes, you do. And it's a huge industry. It's mind-boggling how big the income tax business is. And most people are only familiar with, well, I have to pay all these taxes. Well, it goes way beyond that. The software that's sold for that, the financial planning software, the seminars that are given, it's hundreds of billions of dollars over 3 or 4 years, and just to keep up. So anyway. Very difficult, but just do not forget to take your required minimum distributions. You try to get it out in the year that you want to take it. You take last year's December 31st to calculate what you're supposed to take out this year. Get it done. Just get it done before the end of the year. Can't you wait? Well, some cases you can wait all the way up until you do your taxes, but then you're going to have to take 2 out next year, and that one you will have to get out before the 31st. It's extremely complicated. So don't waste time. Figure out what it is that you've got to take out. Get that out as quickly as you can. It doesn't mean that you have to spend it. And by all means, I would hold back at least 30% of it just to pay the taxes, just to make it easier to pay the taxes. So, and with that, I'm gonna leave that alone. In fact, I only got about 30 seconds. My show is already over. Can't believe it went that fast. Hey, if you hear anything that you want more information on, or if you want to sign up for that newsletter, I send it out once a week. There are actually 4 or 5 articles every week that I like. I get to pick them. And just go to my website. It's bullingtoncapital.com. And I hope you guys have a good week, good investing, and good luck.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420, The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
The preceding program has been paid for by Bullington Capital Management, LLC.